Hey folks, welcome back to Ripe for Investing. Today I'm going to look at an international ETF, ticker symbol DFIV. This is a ETF. It's been around for a while. The ETF has only been around since 2021, but the mutual fund version goes all the way back to 1999. You can look up the old mutual fund version under the ticker symbol DTMIX if you want to do some research. This comes to us from Dimensional Fund Advisors, and it's called the International Value ETF. I will make a disclaimer that this is currently 0.7% of my portfolio, so I do own this one. It's a recent purchase. It is an active managed fund, so it's not a passive fund, but the annual turnover is only 12%. The year before, I think it was like 7%, so it's not like it's flipping stocks. And in fact, one of the philosophies here is basically to minimize federal taxes and maximize long-term capital gains. Not really much of an issue for me because I hold this in my Roth IRA, but those of you that might want to purchase it for your taxable account, that's some information for you. Expense ratio is only 0.27%. I personally don't think it's that bad for an active managed fund. I've got a mid-cap value fund that's like 0.19%. That is a passive fund, so that's not too bad. The dividend yield is 3.88% versus something like 3.21% for VXUS. Just to compare, some of you might want dividends. This ETF currently has 456 holdings versus something like 8,500 for VXUS. So basically, this fund is filtering for low price to book, high profitability, and other things like that. We're kind of looking for those value stocks. At the same time, it does have a minimum market cap standard. I like that. That's, going to filter out possibly some companies that you don't want to have. 80% of it is large to mega cap stocks. Only 20% is mid cap. And this ETF is all developed markets, not really any emerging markets. You'll see here in just a minute when I take a deeper look. I won't go down every single one of the countries, but I'll just kind of quickly sum this up that it is 57% European and 26% Asian. The largest holding right now is Japan at 22%, 12% UK, 10% France, 10% Canada, 10% Switzerland, 1.4% Hong Kong, 6.2% Australia, and something like 0.93% for Singapore. There's some other ones, but that's kind of the gist of it. So you can kind of see that it's a lot of European countries here. Unfortunately, there's no South Korea. I was kind of disappointed in that. But some indexes consider South Korea developed, and some of them consider it emerging markets. So that's why. Let's take a look at the sectors that this thing has. 28% financials, 14% energy, 13% materials, 1.9% tech. I personally see that low percentage of tech as a positive because I've already got plenty of tech in my U.S. equities. The only thing really I don't like about this sector breakdown is the very high percentage of financials. At the same time, VXUS contains 19% financials, so it's not that big of a deal. However, if we do get an economic slowdown, I can expect this to get smashed pretty good. And speaking of that, maybe I'll just tell you what are some of the worst years this thing's ever had. So if we go back to the mutual fund version, back in 2008, it went minus 44% on the year. The second worst year, 2018, minus 17.3%. That's kind of like, worst case scenario. Hopefully we don't get a great financial crisis again and we don't get smashed minus 44% there, right? So that's kind of the breakdown of the sectors, right? So here are the top holdings. Shell, that's your energy company, 3.54%. Novartis, 3.1%. Mercedes-Benz, Toyota, they're like 1.3%. Total Energies, 3.1%. So this is a very balanced portfolio. You're not going to see like 12% or 15% in the top market cap there. So it's a total different kind of approach. Who is this for? I think it's for somebody seeking international diversification that doesn't want China exposure or emerging market exposure. It could be somebody that already has an emerging markets ETF or something like that. It's also for someone that might believe that active management has a purpose and is useful in this type of scenario, and I personally think that's the case here. mostly passive investing with my U.S. equities as far as my ETFs. But here I actually like the idea of the active management. Here are some disclaimers just to kind of throw these out here. This thing has had an absolutely incredible performance the last 3 years, but I think that is largely due to the lack of China exposure here. This thing has beat up on VXUS and VTRIX, which is Vanguard's International Value Mutual Fund there. Over the last couple years, I think the last, let's see, from October 2021 to now, the compound annual growth rate is 6.58%. And if you're keeping track here, it turns out that VU is only 4.71%. So this thing has actually beat VU since October 2021. Last 2.5 years, it's basically been killing it. There's no guarantees that that's going to happen. I will tell you, if I'm just being honest here, if you go back and you actually look at the mutual fund version, over the long term, it actually was beaten by VTRIX, Vanguard's International Value Fund there. So, this could have a great future here, but at the same time, you have to kind of be reasonable about these things. The way I look at this international stuff, I haven't really had international ETFs in my portfolio until recently. This one, I'm kind of buying this understanding, if I'm going to hold this 20 years, that it's probably going to get smashed to smithereens. Like I said earlier, this international stock, it's going to go down probably 40% in my lifetime. And so you just kind of have to be willing to accept that and hold through it. At the same time, I bought VTSAX back in like 2005. So I've been through the great financial crisis. Never sold one share of it, by the way. Never one share. So that's pretty cool. I mean, I have bought and sold things over the years, certainly, but never that particular mutual fund. So this international thing is something that I would plan on buying and holding a very long time. And like I said, I kind of expect that at some point it might get hit with a very large drawdown, okay? But the point here is that this increases the diversification of my own portfolio. And as I get closer to retirement, I think it actually improves the safety of my portfolio. Subscribe if you haven't already done so. Take care.